Hi, so welcome to part 2 of the little wealth supplement that we have here to the Harbour Club. So obviously in part 1 I talked all about your personal balance sheet and how everything measured improves, and around calculating your expenses and then creating this core portfolio that covers your expenses. What I wanted to go into detail on in this section was what you do beyond the core portfolio that can also have some exciting consequences. And this is around creating other kind of mini portfolios. Now, what's interesting is, I often talk about Julius Baer as a private bank. There are, of course, other private banks that you can consider. But when you open an account with Julius Baer, you basically have 100 accounts, or you can have up to 100 accounts that you can nominate for different things. So, you could have a college fund or whatever the different pots are. But what's quite interesting is obviously you can have your number 1 account, which is your core portfolio. This is generating the income for your lifestyle and everything else, and you can be topping up that core portfolio on a regular basis. But you can also have exposure to some other areas. So for example, you could have a fund that was just fixed income, or bonds as they're referred to. So this is, it would be low volatility. It would still be generating some income, and would be considered a very sort of low risk basket of investment. You could have one which could be the aristocrats. I don't know if you've ever heard of the aristocrat strategy, but basically these are companies who have growing dividends. So these are companies that have increased their dividend consistently for 25 years or more. Actually, if you look at an aristocrat portfolio, it's outperformed every other portfolio strategy pretty much on the planet. So it's outperformed even growth stocks. And when you look at some of the things like Netflix and Apple and Amazon that would be included in that growth stock section, the aristocrats have still outperformed those kind of crazy, the growth stock basket of shares. So it outperforms value investing and all of these things. So the great thing about aristocrats is obviously they generate income, so it fits with an income strategy. It's not great for our core portfolio strategy because the income is not that great, so the leverage doesn't carry the positive carry, but it's an interesting strategy to have on its own. If you don't have, I think in the S&P 500 at the moment, there are 51 aristocrats, so 51 companies that have consistently increased their dividends over 25 years. And of course, around the world, there's others. So if you don't want to own 21 different stocks and have all the rebalancing and everything else, there are some ETFs that track aristocrats. But again, remember with ETFs, you do have some fees. So they'll have maybe a 0.35% fee for managing the portfolio for you, or keeping this portfolio for you. But that can be an easy way of having perhaps an auto deduct every month. So you might just put, $5,000 a month or something into the aristocrats and buy them over a long period of time. That will iron out, cyclical changes in valuation as well. So you're buying at lots of different price points. So that can be an interesting little portfolio. I have a conviction stocks pot. So conviction stocks are an interesting one. So conviction stocks might have things like Amazon or Apple or Google, or things like Beyond Meat, BYND is a very popular one. I have that in my conviction stocks pot. Tesla is quite a popular one as a conviction stock. If you really believe in Elon Musk and you believe in electric cars as a future, you might hold that as a conviction stock because you just think it's going to be a game changer over time. It could be some new listing that you feel strongly about or passionate about, or is in a sector that you have an understanding of, but doesn't really fit in the core portfolio strategy. Another good thing that you could put into the conviction stocks section are agglomeration stocks. Now, agglomeration stocks can tick a couple of boxes for you. Obviously it gives you access to small business and gives you the opportunity to grow as we add more companies into an agglomeration. But we also have an opportunity where you can get asymmetric risk from agglomeration investing. Now, we talk about asymmetric risk on the Harbour Club. To remind you, that's where your downside is protected, so you only have upside. So if you take away the downside, you can be a lot more bullish about your investments. So if you would like to do some asymmetric risk investing in agglomeration stocks, I'll do another video about that after this one, where I'll just focus on how you do this asymmetric agglomeration investing. So, but to stick to what we're talking about now, we obviously have, you could have a bond portfolio, you could have an aristocrat portfolio, you could have a conviction stocks portfolio. You can use the all-weather portfolio, which is very popular, which was in the Tony Robbins book. It was designed by one of the greatest hedge fund managers of our time, and he created this all-weather portfolio, which he says would have been the strongest portfolio over the last, 1,000 years or something. I'm joking. The last 100 years or something. So it's very easy to find out about it. Just go onto YouTube and put all-weather portfolio, or Google Tony Robbins all-weather portfolio. You'll see the structure of that one. So you might want that in one of these separate portfolios. You could have a pure real estate investment trust portfolio. So just, I've talked before about having this big diversification across real estate. You might want to have one little portfolio that focuses just on that. Another one which has been really popular with Harbour clubbers that I talk to on a regular basis. So if you're on the private banking ladder and you've done the Harbour Club, you can join the Singapore Wealth Circle. It's completely free. We have a call once a month where we just talk about what we're investing in and what the market's doing and what other products and services and things are out there. One of the experiments we started about a year and a half ago was something called dividend capture. Now, dividend capture can be an interesting strategy for one of these sub portfolios. And basically how dividend capture works is when a large company pays, or when any company pays a dividend, the exchange, the stock exchange that it's listed on, say it's the New York Stock Exchange, the day that the dividend is announced, it's called the ex-dividend date, the day the stock goes ex-dividend, then they take the amount of cash that's going to be distributed under the dividend and they reduce the company's market capitalization by that amount of cash. So the market cap is basically the share price multiplied by the number of shares in issue. So by reducing the market cap, what they actually do is reduce the share price very slightly, because what they're saying is, well, the company was worth €1.24 a share when it had all this money in the bank, but it's now not going to have all this money in the bank, so it should be worth less. That's the kind of rationale. But of course, pricing of a share is actually more based on what people think the business is going to do in the future. So what tends to happen with very big companies, if you're Unilever or Microsoft or Goldman Sachs or one of these types of companies, what will happen is that when you go ex-dividend, your share price will drop because the exchange will adjust the price, and then everybody will just buy it back to the same price as it was before it went ex-dividend. So the correction only lasts for a matter of days. Now, there's a really good resource, and in fact, this is a good resource for things like the aristocrats and stuff like that as well. There's an American website called dividend.com, and you go onto dividend.com, get a premium subscription. It's only about $150 US. And if you go into the different lists that they have, one of them they have is called dividend capture stocks. Now, what they give you is the name of the company, but they cover every company in the US, so you have to do a little bit of filtering. Give you the name of the company, they give you the amount of the dividend, they give you the date that it's going ex-dividend. Now, this is important because if you own the stock on the date that it goes ex-dividend, then you capture the dividend. You get the benefit of that dividend when it's issued. It gives you a DARS rating. Now, a DARS rating is their own criteria that they use for judging these companies, and basically it's the strength of their ability to continue paying dividends and just the strength of the company in general. So it's quite a good indicator that this is a good one to have in the collection. And then you also have the average number of days historically it's taken for the stock to recover after that correction that the exchange puts on it. So a good one will be recovering in kind of less than a week, and will have a DARS rating of more than 4 because the maximum is 5, and have a dividend more than maybe 0.3% because a lot of American stocks pay quarterly dividends. So 0.3 would be kind of multiplied by 4. You'd be able to do that 4 times in the year. Now, what we then do is we effectively buy the share on the day before it goes ex-dividend. Now, there's two ways you can do this, but I'll tell you the way that we do it. So you can buy the stock when it goes ex-dividend, and you could just sell it a week later when the price is recovered, and you could capture that 0.3% over a week. And actually, that wouldn't be a bad strategy because blue chip stocks have this 70% loan to value that we talked about in the last video. It means that you could put 30,000, say, into Microsoft. That would give you 100,000 of Microsoft. You'd get 0.3 of a percent on it for a week. So effectively, it would be an annualized return that would look quite healthy. However, there's something you can do that's a little bit more sexy, and that is to sell a covered call. Now, we're back into derivatives again, but a covered call is basically an agreement to sell the share when it gets back to its recovered price. These are sold in contracts of 100, so you have to buy 100 shares of whatever it is that you're buying, and of course some shares are $10 and some are $1,000, so that will dictate how much you need to invest for this strategy to work. You basically take these 100 contracts on your on the shares that you've bought. All of the covered calls expire on the same date every month. It's usually the 19th or 20th of the month, depending when weekends fall. So depending the date it goes ex-dividend depends how long you're then holding the stock. So for example, if it went ex-dividend on the 24th of the month, you'd be holding it almost a month until the 19th of the following month when the covered call would expire. If it was on the 10th of the month, you'd only be holding it for 9 days. So there are different holding amounts of time that you would need to do. But the really good thing is a lot of these covered calls are paying like 2% or 2.5 or even 2.7% at a price that's very close to the recovery price. So for example, I mean, companies that I do this with, I've done it with Pepsi, with Coca-Cola, with Microsoft, with Unilever, with Procter & Gamble, with Goldman Sachs. So these are all companies that I think you'd like to own in your portfolio. These are all companies that you would be quite happy having in a portfolio over the longer term. But what we do is we buy the stock when it goes ex-dividend, we sell the covered call, and what that does is it gives you, with the dividend and the covered call premium added together, it gives you about a 3% return on the funds that are being deployed. Now, what's interesting is, again, if you use that little bit of leverage, so if you only put 30 grand in, but you're buying 100 grand's worth, then your 3% effectively gets around to 10%. So effectively then you're making 10% in 2 to 3 weeks of holding the stock. And you can do that 4 times a year. So Microsoft issues 4 dividends a year, Procter & Gamble does, so does all the ones I mentioned, Goldman Sachs. So you're effectively making 10% return 4 times a year, which would be 40% per year, but you only have your capital at risk. You only have your money deployed for maybe, if it's 3 weeks that you're holding the covered call, it might be 12 weeks overall. Now, I mentioned in the last email that corrections and things tend to come by surprise, but they don't tend to last for that long. So the risk with this strategy is that you end up holding these stocks just in the 3-week period or 2-week period that you're holding them, that there's a correction or a market crash. So you might find, I mean, the great thing about this is the ex-dividend dates of these companies are all at different times. So effectively you would have some you could deploy in, January, some different ones in February, some different ones in March, and then it would be the same ones again that you did in January and April, and so on and so forth. So you'd always be deploying into different companies and then getting your funds back out again. And the risk would be that there was a crash at any one of those points. And if there's a crash at any one of those points, then you've still got the covered call premium, you've still got the dividend income, but the stock is now worth less than it was when you started. And then you can just take a view as to whether you just sell it, because you would have been exposed to lots of different covered calls, and you can maybe just roll over and do it again next month and at the new market levels or whatever it is. You might decide to keep it and allow time for it to recover, because these are big blue chip companies. So depending on what's caused the crash, whether it's a general market sentiment thing or a specific company thing that's caused the issue, you could decide what you do. In fact, I've been doing this for a year. I've only ended up owning one stock, which was McDonald's. And in McDonald's, it was the CEO of McDonald's got caught up in some sexual harassment scandal, and that knocked a bit of value off McDonald's. So the covered call didn't get triggered, and I still ended up owning McDonald's. So I took a view on it that I was probably the stock price was probably about 5% below where I bought it. And I took a view that because I was kind of 10% in front on the mixture of the covered calls and the dividend, I might as well just sell it and then go and do another one, because there were other companies that I could do these dividend captures with the next month. So I figured it was better to get the cash out and go and deploy again and again and again, even if there was that very small loss on that one, bearing in mind I'd done dozens of these in the months before that had all worked out really well. Actually, McDonald's recovered and went on to storm really high, so if I kept it, it probably would have done better. In fact, with most of these, had I kept them, because the stock market's been so bullish recently, I probably would have made more money keeping them. But I quite like this idea of dipping into the market and coming out of the market and just creaming a 10% return on my money while I'm in there. It really is quite an interesting little strategy, and it's one that we talk about quite regularly on our group calls in the Singapore Wealth Circle, because lots of us are trying it, and it's been working really, really well for the last year or so, and it's quite a good way of enhancing the value of the portfolio with little bits of exposure every so often. So yeah, you could have this dividend capture strategy could be something that you do with some spare cash that's sitting in one of these sub-portfolios. But get your core portfolio right first, then start looking at the sub-portfolios, which could be dividend capture, could be aristocrat, could be bonds, could be the all-weather portfolio, could be real estate, and then the other one is conviction. And like I say, in the next video, I'm going to be talking about how you can do an asymmetric risk approach to agglomeration, which could also help you get on the private banking ladder as well. So join me for the next video where we'll be going through that. Thank you.